Good afternoon and welcome to our webinar, The Mortgage Platform for the Digital Age. My name is Jim Tebay, VP of Business Development at eOriginal, and we would like to thank all of you for joining us this afternoon. In looking at our attendees, we see representatives from mortgage originators, marketplace lenders, custodians, secondary market investors, warehouse lenders, as well as representatives from both compliance and risk management. By way of background, eOriginal, while best known for its e-contracting platform for vehicle finance, lending, student loans, vacation ownership, and marketplace lending, that e-contracting platform has actually been used for eMortgages for over 10 years and executed the first eMortgages back in 2000. Today, we're introducing a much broader eMortgage ecosystem that integrates other critical functions such as notarization, land recording, buyer education, custodians, and warehouse lending. Our two panelists today will introduce this ecosystem in the context of key industry issues, including the business drivers that are breaking down the barriers to a fully digital mortgage, the advantages of using a platform that offers both MERS and non-MERS closings while providing greater data transparency and analytics. And then, looking beyond TRID, or I'm sure for many of you just finally getting past TRID, what will be some of the impacts of the new regulations facing the mortgage industry? I would now like to introduce our two panelists, Steve Bisbee and Tom Booker. Steve is President, CEO, and founder of eOriginal, and one of the more notable pioneers of digital transaction management, including e-signature, e-vaulting, and securitization. Steve has also had major roles in many of the associations that created today's legal standards for electronic commerce. Tom Booker is Managing Director of the Collingwood Group, a DC-based business advisory service to boards and executives in the financial services sector. Prior to this, Tom compiled a significant track record as Senior Vice President at CoreLogic and First American Financial. And certainly no stranger to the e-mortgage industry, Tom was Vice President of e-business strategy and market development at Fannie Mae. Now, before we kick off, let's do some quick housekeeping. First, please raise your questions by keying them into the sidebar, and we will either pose them to our panelists during appropriate points in their discussion or at the end, depending on the context of each question. And while we've designed this as a one-hour session with 15 minutes allocated for Q&A, if we do run out of time for some of the questions, we will provide responses to these in the recorded version of this webinar, which we will provide to all registrants. All right, let's get started. Tom and Steve, where are we today in terms of adopting fully electronic mortgages? After all, it's been 15 years since you first showed that it could be done. Why is it taking so long? Tom, let's start with you.
Thanks, Jim. Well, the challenge, the challenges that we face today really were kind of derived from some things in the past. You know, when you think about the e-business mortgage concept, it's best described as a method to replace paper and the challenges of handling paper that would bring efficiency and a more effective means of interacting with all the parties associated with originating, servicing, and owning a mortgage asset. I mean, that's at the heart of what we're talking about here. And 15 years ago, when the internet first became recognized as a communication tool that may have some commercial use, a lot of the drivers and a lot of the capital that flowed into the industry that pursued that end really did do it with trying to get to that outcome as the driver. The complexity of data, document, and communication standards really was the talk of the time. And frankly, though great dollars and a lot of intent was expended, it was very difficult to overcome some of the, for lack of a better term, language inertia that existed around that. However, if we fast forward to today, it's quite different. The internet is still evolving. However, the tools are far more mature, and the utility of doing business, the leverage around the reduced cost in this business model, greater reach, and a real device for enabling one-on-one or very precise marketing really do drive a set of the value propositions generally as it pertains to the internet and internet finance. Most importantly, the regulators and investors have focused on consumer protection, process transparency, and loan and data quality as the core values that will form the basis of the value proposition they expect to be delivered from this platform. So in that 15-year period, and we had this little thing called the financial crisis in the middle, there's been a tremendous change both in terms of the maturity of the internet and, frankly, the fact that major investors and regulators have caught up and begun to think about the ways that data, not necessarily the internet itself, but data can be helpful. Moving forward, for mortgage lenders, what's going to be important is that the mortgage may be more of a product than it is a process. The interest in a mortgage is a consumer interest, and I think that's one of the key things that marketplace lenders have keyed on, that consumers want to get a house, want to get a refinance transaction done, but they don't necessarily want a mortgage. So if you can deliver the product as an event and make it easy and precise and not so burdensome, there's a real differentiating value. But we shouldn't believe that that innovation is just purely the province of new entrants. A number of the traditional players in the marketplace understand that that's a barrier to their progress as well and are trying to take advantage of similar kinds of technologies. One of the innovations that's occurred over the last 15 years is that 15 years ago, the organizations that built those capabilities also originated those loans. In many cases today, the originating party and the technology-based originator are different organizations, allowing legacy providers to participate in these transactions, whether initiated by marketplace lenders or initiated by the lenders themselves. And that's really one of the ways that's going to move this along a lot more quickly. All of the speed and convenience we see moving forward will be enabled by digital tools, which will allow convenience, speed, and loan quality, and the transparency that regulators require. But all in all, what the big deal is moving forward is that data, manipulation of data, transparency of data is going to drive regulatory review, is going to drive investor acceptance, and frankly, in many cases, is going to be one of the ways that more knowledgeable consumers understand that they've consumed a product that meets their standards. So from my perspective, huge changes have occurred, still more work to do, but we're on the precipice of something great. Steve?
Thank you, Tom. So where does eOriginal fit into this adoption cycle? Well, eOriginal was founded in 1996 to enable fully electronic mortgages. It's difficult to remember at that time there was no internet for financial services. We relied on the large WANs, EDS, and IBM to be able to provide the technology foundation and infrastructure for us to create the fully electronic mortgage. We had players like Flagstar, Fannie. Tom Booker was involved in that, the Fannie support of our project at that time, Stewart Title, and many others. Originators, lenders, some of the major title underwriters, land records, state secretaries of state, and notaries. We completed the first fully electronic mortgage transaction, that's from origination all the way out into the secondary market, purchased by Fannie in Broward County in the year 2000. We then moved forward and had a rollout in four states from going in 2000 to 2001, 2002. The tech bubble burst in 2001, 2002, put not only a halt to the progress for eMortgage, but much of the electronic transaction enablement that was being developed at that time. eOriginal diverted from mortgage to auto finance. We were happily engaged with the large auto portals, Dealertrack and Route 1. Either one or both of them are in all of the 17,000 franchise auto dealerships today, and as well as Chrysler Financial, as they were really moving towards e-contracting, that asset class for auto loans, and securitization at a faster pace. Today, eOriginal has continued to work with one of the leaders in eMortgage enablement, Fiserv. Many of the folks on the phone know Fiserv and Kim Weaver and the efforts that they have been making over the last decade, as well as working with Fidelity Information Systems to provide the technology platform for their TRID offering. Why is eOriginal coming back to the space today? Well, in late 2014, we are involved in enabling vacation ownership, fully electronic vacation ownership, assets to be executed and purchased. Many of them are done under trust, but a lot of them are also done on deeds where they're actually true mortgages. And our customers would like to move into the true mortgage space, and we'll talk a little bit more about that. But also, as Jim mentioned, we're also a platform for marketplace lending, and they're looking to leverage eOriginal. A couple of examples, Social Finance, Lending Club, and Prosper have all said that they're going to be moving into the mortgage space. In a recent article, Bloomberg article on Silicon Valley's taking a piece of the U.S. mortgage market, it was noted that SoFi now is doing only about $50 million worth of mortgages a month, but in 2016 they plan to do $3 billion. Now that is a fly speck, as they said in the article, in the $1.45 trillion mortgage market, U.S. mortgage market, but it's evidence of a trend. One of the things that we noticed, part of that trend is that there's been, in 2014, about 38% of all the loans, mortgage loans, were created by non-banks. And Bill Emerson, who's the CEO of Quicken Loans, who is the largest non-bank, was just elected chairman of the Mortgage Bankers Association. Also, the CFPB came to us because we had created this data-driven platform some time ago to look at how we could assist them in enabling compliance and monitoring at an asset level and still have the transparency that they were looking for in the enforcement of their regulations. So that's where we are today. That's where we came to be building out the platform we're going to demonstrate to you today or describe to you today. But where are we going to go? We see that there is a need for this multi-party, a very consistent platform, and that it has to be plug and play. This is not going to be able to be done by one technology company or one originator or one mortgage lender. We have to be able to find a way to minimize the complexity of compliance. It's becoming a crucial issue, as Tom will talk about in a few minutes. We see that 2016 is going to be sort of the foundational creation of this platform and its utilization with early adopters, but by 2017 we see a very broad market adoption of fully electronic mortgages.
All right, gentlemen, that helps define the landscape, but you mentioned some of the business drivers. Can you go into these in a bit more detail? Tom, let's start with you.
Yeah, Jim, I sure will. Once upon a time, business people yearned for regulation as a method and a standard to separate legitimate actors from those who were not. Today, the mortgage market struggles through the second-order challenge of interpreting and complying with the regulations that define good practice in today's environment. Amongst the most difficult is the idea of transparency. Transparency is something that in finance, let alone in the mortgage business, has not been a driver of any of the processes to date. As a matter of fact, what you'd like to do is you'd like to be able to originate a loan, be able to solve for whatever it takes to get the loan papered, and then be able to actually sell that loan off as quickly as possible. Transparency is not one of the things that was driving that process at all. The cost and ambiguity associated with today's origination process is a legacy challenge that a generation of LOS providers and mortgage origination fulfillment providers have been trying to address with limited success. With the dawning of a new regulator, the CFPB, and their focus on a new regulatory regimen, which is based upon data, it really has become important for organizations to be able to manage and be able to expose the data both in process and as a result of the process in order to meet the needs of the regulator, if not the investor as well. As low interest rates and a recovering economy and a more knowledgeable consumer breed a new set of innovators who have taken to solving for the origination challenge while advancing the goal of broadening the pool of those who can qualify for a mortgage by doing things like simplifying the ability to repay and serving underserved markets like small business owners and people with multiple employment sources. The challenge and the mortgage market drivers are really very clear. There's a market to be served that hasn't been well served in the past. There's a set of cost opportunities that can be taken advantage of to be able to manage some of the exposure you now have in compliance and interpreting regulations. And then most importantly, you can do that in such a fashion that you can reduce the time it takes to originate and fund a loan. So rarely have you seen the combination of a market coming together with the tools necessary to make that market an attractive place for businesses to do business. Steve, do you want to talk a little bit about the consumer expectations?
Thank you, Tom. One of the primary ones is mobile. We're all familiar with the need to be close to your mobile instrument and how much you utilize it now to manage your life. A great example is in the beginning of this year, you would see lines where people were getting their boarding passes at airports, and a few would have utilized their phones. Now, at this end of the year, almost everybody is utilizing their phone for boarding passes. But it's the expectation of consumers that they're going to be able to interact and do their business through their phone. In the article, the Bloomberg article I just mentioned, they referenced a 30-year-old marketing manager who was getting a mortgage for $980,000. And he did all of his docs and application and completion of his docs on a phone in a bar. And his main statement was that SoFi did not inconvenience his life. If it wasn't on a mobile, it's a pain in the butt, and I wouldn't do it. So it's not just for the millennials that are really the expectation for millennials is that they are not brick and mortar, they are not paper-based, they expect to be able to do everything online and through their phone. So one of the things that the technology companies today are providing is that capability. And some of the large fintech companies are focusing on being able to deliver mortgage applications and even possibly closings through a phone or mobile device. Okay. Speed. There's a race to approve. The origination process has to get quicker. Again, as Tom said, the utilization of technology is going to enable that. The expectation is that people are impatient. They want to be able to do their transactions as quick as possibly. Simplicity. The mortgage transaction is a very complex one because it's multiple parties and different time periods. It has to become more simple. Investor liability. It wasn't that long ago where if you were purchasing a mortgage in the secondary market, there were hold and due course protections, but now with various regulations and the enforcement of the regulations, there's increasing investor liability downstream. Compliance, as we said, has really become one of the biggest issues in mortgage, and Tom's going to speak about that. But also, one of the things we're seeing from the CFPB, not just the CFPC, the Fed, and the OCC, is they want to be able to monitor the assets, the actual mortgages, to know what happened to them when, in the relationship with the consumer, in real time. Tom?
Sure. As we move forward, the gating issues that'll be the key insights into broader adoption are really far fewer than they were 15 years ago. One of the observations I would make, and I'll offer this as a way to think about this, is that, risk capital is not attracted to places where it doesn't believe it can get a return. And the mortgage business has not been thought of as a place where there are huge returns. However, if you can broaden the market, if you can get more people involved than have been involved in the past, and you can get better yields because of lower cost and greater leverage out of that transaction, it begins to look like a place where risk capital is beginning to flow. Just this year, there is a marketplace lender that is focused on being a mortgage company that was able to float an offering to foreign investors for $400 million. So when you really begin to talk about the kind of capital that's flowing into this business space to fund these activities, the money is real and it's coming at scales that we haven't seen in a long time. Over $1.9 billion flowed into the markets to be able to drive the kind of innovation we're going to discuss today. But when you talk about readiness and productivity, one of the key factors is, are the supply chains ready? And frankly, are you able to assemble those supply chains so that you can reach a cost profile that allows you to participate at the scale and make the kind of dollars your investors would expect you to take away? We believe that's taking place. This whole idea of transparency, and I keep focusing on this because 10 years ago, transparency wasn't a concept. It wasn't something that as a business person, even when you were looking at compliance, you were trying to achieve. Not only are you trying to achieve transparency, but you're also trying to manage the data, because ultimately what it means is that the data's got to be timely, it's got to be accurate, and frankly, it's got to persist from the points at which it originated to the points at which it comes to rest. So if you look at what's going to drive not only the trust by all parties, but it's going to drive the kinds of innovations that will allow greater and greater confidence around serving the underserved markets I spoke to earlier, the ability to have data be the driver and data give everyone an ability to make their own judgments is very, very critical. Last but not least, in every technology-based innovation, there's this whole concept of the last mile. That's something that I did bring back from 2000, where we used to always talk about that as the last mile in the context of telecommunications companies between the main trunk and everyone's homes. Well, what that really is today in the mortgage business is e-recording, e-notary, and being able to get some confidence that what you've done electronically or digitally is actually going to end up in the record, so that when others check the record, it doesn't take 30 days to figure out that you did the right thing. I have great confidence, and there's great evidence that not only are these things coming together, but they're coming together at a speed and in a fashion that makes them very consumable for commercial activities. And that's really a key point. As we move forward, we're going to talk more and more about how those systems come together and where eOriginal plays a role.
Thank you, gentlemen. And now that you've talked about some of what must be overcome, Steve, tell us how are you going to address these business drivers and adoption issues?
Well, thanks, Jim. The real question is how can you position your company to offer a fully electronic mortgage platform without having to create or assemble all the required capabilities? How can you have a consistent, complete solution that will give you the speed and acceptance that you need? So eOriginal has had the experience in the past of doing so, but revisited the various players and the needs have changed somewhat. Tom will talk about that. But for us, we had to develop an eMortgage platform that was positioned for marketplace lending. That was our first goal, because the marketplace lenders they originated, they had the funds available, but they didn't have the normal infrastructure that financial services companies did in relationships, as Tom mentioned, whether it be in the notarization or e-recordation. It had to be a single platform. It had to be loan origination system agnostic. It had to have both MERS and non-MERS capability, and it had to have a plug and play. And by plug and play, we just mean that various participants can utilize the platform for different types of capabilities. And it has to have a user-configurable dashboard that you'd be able to get the data and the analysis of the data, the trusted data, and we're going to talk about that, for monitoring and reporting. So what do you need? You're going to need the e-notarization. You're going to need buyer education disclosure, e-recording. You have to have warehouse lending involved, electronic custodians. You obviously have to have smart doc capability in closing. You have to be able to enable the MERS, e-note, and registry and the transfers and the benefits that the registry brings. And so eOriginal, as Jim mentioned, we have this core processing. It's been vetted in many other industries. We have been approved by rating agencies, issuers council, major lenders, and the secondary market. So then eOriginal looked out to the partners that would be able to help us provide these capabilities. Simplifile. Paul Clifford has been at this for 16 years, he and Mark Ladd, and they have done the heaviest lifting in enabling on a county-by-county basis electronic recordation. They're in 1,341 counties, covering over 70% of the U.S. population. They have a great user experience, and it isn't just for mortgage. Digital Docs, Chris Christensen and his team are a leading provider of MISMO compliant and smart docs and closing room. They're MERS certified, and they are TRID hardened and proven. Their technology has withstood a lot of the battles recently with TRID. Doc Verified, Darcy Mayer and his team has created a national platform for in-person notary. They have the largest group of registered participants, notary participants, and they have an identity verification offering as well. Notary Cam, Rick Trulio. Rick Trulio is actually a 20-year veteran. He actually built in late 90s a real estate transaction platform, but in 2012, with the Virginia statute, which enabled remote notarization, he built Notary Cam, fulfilling the requirements of Virginia, and created a network of trained and certified e-notaries, and he's received already many awards for innovation, including one from Realogy, one of the largest real estate companies. Informa is a Florida technology company. They're a can-do enabling firm. They're a leader in vacation ownership and transaction enablement. They have built in also an e-notary and e-recording capability for those specific counties and states where they are working in vacation ownership. Mike James and Russ Ramsky have been a great partner with us already. Bid Verify, Jim mentioned earlier about the CFPB and transparency, especially around disclosures. And Bid Verify, Tim Stern's group, was referred to us by the CFPB, the know before you buy, making sure you have consumable knowledge. All of us know that a lot of disclosures that are delivered in the mortgage process are not easily consumable. They have created a great, easy-to-use video disclosure capability that provides not only transparency, but the record of delivery and the utilization of the tool. Warehouse lending. Many people on the webinar may be familiar with Stanley Street and Street Resource Group. Stanley has led his group for 29 years in warehouse lending technology. He's the technology for 60% of the warehouse lenders. His awards are, there's just so many wouldn't want to list today, but it includes the 2015 Mortgage Bankers Tech All-Star Award, and Stanley personally is one of the leaders in the e-warehouse initiative for the Mortgage Bankers Association. So what does this process look like? Well, let's look first at the MERS MISMO. MISMO and then MERS, when they took over the note registry or took up the gauntlet for the note registry, depending on how you look at it, they took the lead. They got a commitment from the industry. And as a matter of fact, eOriginals' first eMortgage platform was built by EDS, by the same folks that built the first MERS platform many, many, many years ago. So if you're going from left to right, from our perspective, it really starts with the real estate contracts. If we can capture data from the real estate contracts as well, which is now possible, that would be very helpful in terms of how we would apply our data lake capability. Loan servicing, fully electronic. Most of these aspects are delivered electronic today. Origination and underwriting. This goes back to Tom and in his youth in terms of desktop underwriter and loan prospector, and now there's so many others. But in this instance, of course, they have to have MISMO XML and or Smart Docs. Doc Prep, there are companies out there that are certified Smart Doc providers, Digital Doc, CSI, Walters Kluwer, and others. You have to enable the disclosure, including TRID and the e-package, and e-delivery. A number of years ago, e-delivery was very difficult to achieve, and now, of course, it's become very much simpler, but it's still a critical element of that. When you get to the closing table, you have to have the ability to do the electronic notarization, as well as the e-closing. And in the e-closing world, this is a specialty of Digital Docs as well. Enabling the e-recording through Simplifile, warehouse lending through Street Resource Group. There are services that would be familiar names to those on the webinar that we're in the process of working with to add to this process. In terms of the custodian side of this, U.S. Bank recently announced their partnership with eOriginal to be able to be the custodian for all types of asset classes. Wilmington Trust, Millennium Trust, they are the primary custodians in the marketplace lending world. Equian is one of the primary custodians, really one of the primary custodians in the vacation ownership world. And there are other names that will be familiar to you in terms of the custodian. When the documents are executed, you have to have the ability to be able to obviously vault it in an eVault, and there are a number of providers that provide that capability today, including this platform, and be able to put the registry out on, to be able to report the note, control the note out on the National eNote Registry operated by MERS. You'll see along the bottom of this slide a reference to datalytics. One of the things that has come to the fore in terms of having fully electronic mortgages is having trusted data that is linked to verifiable documents. Datalytics provides full data sets at the document level, at the transaction sets, and at the portfolio level, which enables full infographics analysis of the documents and their data in those transactions. It also includes the ability to have anomaly notification if, for instance, there's a difference between the data that was used to create a disclosure and the data that was used to create the closing documents. Notices can be provided to assist in compliance, the compliance officers within the mortgage company, but also for regulatory compliance as well. Okay. The non-MERS world. This is, as Tom said, this is the practical nature. MERS has not been able to capture the full mortgage market. Everyone's aware of that, including MERS. We're hopeful that this platform will assist in greater adoption of MERS, but we also have to provide an alternative to credit unions, community banks, those that are non-Fannie and non-Freddie loans, and especially for marketplace and alternative lenders, some of which are already committed to being able to sell into Fannie and Freddie, and some of which were not. So if you look at this, you'll see the participants are very familiar to the last slide. The only difference is that the documents do not have to be MISMO compliant. There is not a need for the MERS registry. And this is the process which we have been using for all other asset classes, and a similar process that we used to create the first electronic mortgages so many years ago. The application of datalytics would apply just as it would in the MERS example.
So as we begin to think about what the consumer experience looks like and what that really means to adoption, I wanted to kind of give you a sense for where we stand today. So at the left-hand side of this chart, you've got an experience that I'm just going to pick on internet customer service because we've all had that experience, which is largely typified by an inability to get someone on the phone, an inability to get your question answered in a timely fashion, and then frankly, a whole set of challenges around being able to make certain that if you have a subsequent problem, you can actually find the right party to be able to interact with. That's at the low end of the score. If you look at where residential mortgage servicing and you look at where residential mortgage origination are, we aren't far from the internet customer service set of thresholds. That's not the best neighborhood to be in, but frankly, a lot of what we've discussed today really will have an impact on being able to allow the cost of customer service, the accessibility of customer service, and the accuracy and results of customer service to be much more effective. So if you begin to look at this chart at the right side, you see U.S. dealer financing and U.S. dealer leasing. If you looked at this chart 5 to 7 years ago, you would have seen those two industries, and this is auto dealer financing and auto dealer leasing, you would have seen those two bars down in the same neighborhood where residential mortgage servicing and residential mortgage origination are today. And a lot of what's happened over that period of time, above and beyond what the automakers have done with their products, what they've done to reconfigure their dealer networks, they've also made the dealer floor a far more friendly place. And a lot of what's made that happen is that the transaction now takes far less time, is very data-driven, is easy to execute, and it feels a lot more like I'm just going to buy something at a retail store than it does feel like a commercial transaction. What's important about this is that eOriginal has taken a lot of the capabilities that they have and brought them to bear on the lion's share of the loans that are made in the United States and the auto dealer leasing and the auto dealer sales space. So when you really talk about being able to trace an asset and being able to make that process around tracking the asset as well as securitizing the loan, eOriginal has been involved in that process and has made that happen at a scale that I don't think any other company has been able to do to date. So as we move forward, being able to it's possible to move the residential mortgage servicing and residential origination experience to a place using these kinds of technologies and meeting the needs of regulators such that we can begin to look a lot more like the auto business, which right now is having a booming year. I'm going to now talk a little bit about where we've come from and how we've gotten here. And forgive me for the eye chart, but this is a chart that really does make 2 points. At the left-hand side, you see originations in the fourth quarter of 2009 costing in a neighborhood of $2,300. So if I'm going to show you a chart right after this that says that's actually a pretty high watermark if you went back just 3 years before and looked at what origination would cost. So by 2009, and we didn't have the impact of a lot of the regulations that have come to bear, you had a huge shift in the cost of origination. The second point here is that this cost is driven as much by concerns and fear as it is about the implementation of technology and the implementation of new processes. And let me get into that a little bit. Part of what I've showed here is that if you look at some of the rulemaking that's occurred over time, and you look at what's been happening with the examination regimen, you look at how that has shifted over time, and frankly, the focus on data, which now makes the examination not one of what I'm going to call a set piece, i.e., let me come and see what you do, let me come and look at your process, but actually let's review your data, let's review what you have done, let's review the complaints that have occurred against you, and let's look at what the actual results are. It's been very difficult for the industry to originate loans and be able to effectively respond to a regulator as they come and query them on the results. So part of what you're also going to see in this chart is you're going to see situations where in 2013 and 2014, 2015, there have been significant penalties and restitution paid by organizations that have not been able to, one, be able to manage and understand what compliance means, and then two, be able to demonstrate that in a fashion that allows them to avoid these kinds of penalties. That combination of interpretation and then the penalties that result have really created a focus on doing whatever you can to make the effort clear and observable that you're trying to comply, when in fact you may not be able to make much headway in being able to comply at all. So as we look forward, being able to manage data and being able to make sure that data allows you to demonstrate your compliance is a critical standard. When we go back, and I talked a little bit about 2006, these are charts that I actually took from a previous life. It's from a publication that I dug up for this call where we looked at what origination costs were in 2005 and 2006. Mortgage Focus was actually a published activity that Fannie Mae ran during that period that tracked origination costs. And the point of these two charts is to focus on what drove the expectations back in that day for lower origination costs. So the first thing I'd like to bring your attention to is if you look at these costs, they're all much lower than they are today. So if you go back 10 years, how many things can we say are much lower today, are much lower then than they were today? The second point is if you begin to look at where the cheapest origination costs are, it's in credit unions, and the highest was in wholesale lending. So there were a set of challenges. But I think the key point here is the benefit that really did accrue to the industry was around being able to manage the application data such that you could very rapidly and systemically return a response of either you qualify for a loan or you do not, and you had what you needed to be able to make a mortgage loan occur. Well, that in that day was a huge innovation, and it really did do a lot to diminish the cost of origination. However, moving forward, the challenge is far greater. When you look at the experience today, the same set of productivity numbers that we had in 2006 really do typify the mortgage experience today. So if we look at this chart, on the left-hand side, you've got closed loans per month and then applications taken per month. Those two numbers, which we start on this chart in 2008, and this is from a Stratmore sample, and they're very, very good at taking these numbers, and they've tracked this over time. The same numbers that you see in 2008, though I don't have 2006 up there, you're going to have to take my word for it, are largely the same as they were in 2006. So if you look at 2013, where they've moved nicely from 3.4 closed applications a month to 5.7, and closed loans per month, and if you look at 7.7 applications, it looks like it moves nicely. However, if you look at the market in 2013, it was largely a refinance market. It wasn't a purchase market. So I know every mortgage market is different, but my point here is that the productivity that you have in terms of loan officers hasn't really increased since 2006. So we're bordering on 9 years, maybe 10 years at the end of next year. And the ability to take on more burdens and more interpretation that's associated with regulation and the complexity associated with it, sometimes you could argue makes these numbers look pretty good. I'd suggest to you as a business owner, I've got to not only get better in terms of making those judgments, but I also need to be able to get much higher productivity out of my resources. But when I look at the other resources involved, the non-producing direct FTE, we've actually had the opposite experience. In 2008, they were actually more productive because there was a clear idea of what you had to do, and frankly, there was a new automated tool, this automated underwriting thing that we now take for granted, that really helped them drive the curve and be able to get more closed loans per month and take in more applications per month. But as you begin to look, even in a refi year, you're beginning to see that fall from where it was in 2008. So the combination of having your most productive and most critical resource, loan officers, not be able to get the kind of support they need from folks who want to do the best they can, but just are in a circumstance where they're having to make too many judgments without support of the systems that would help them automate those judgments, really does lead to a circumstance where being able to increase productivity is difficult. In this chart, what I've tried to do is I'd like to focus you on a couple of things. On the top line, if you look at compensation and commissions, and I'm not going to deal with why these numbers are what they are, but the point is that is the state of the industry as it is today. And so as a result, those parties tend to be the leading edge, the tip of the sword in terms of being able to source loans in the marketplace. If you look at that, those are folks that over time have seen higher and higher compensation in terms of commissions and non-commission, as well as you've seen an increase in total production expense. It's not a one-to-one ratio, but what you're seeing is that those parties are really the key parties that you need to be able to make more productive. So when we talk about what it means to be able to drive a business model, what's got to happen is that you actually have got to get more loans, more applications, and then you've got to be able to process those applications and loans in a fashion that allows you to be able to get a lower cost of origination and a lower total cost for the enterprise. In this space, it's very difficult to do so with the tools that the traditional legacy loan originator has to bear. The LOS providers have done their level best to be able to try to add whatever they can as extensions to the LOS, but there's more that needs to happen, and eOriginal has taken on that more that allows what happens in the LOS to move forward through the balance of the process into e-closing, and then creating an asset that an investor can have a high degree of confidence and trust in because they can get access to that data. This is where the two worlds begin to come together. So when we look at where we are today, I'm going to suggest that increased regulation is an easy scapegoat for regulatory reach, because as a matter of course, when you look at managing data, which is a relatively new discipline from both a business and regulatory perspective in the mortgage business, what you're going to see is more and more regulation. You're going to see a much greater bias for interrogating that regulation. It's going to happen more frequently. There are going to be more demands placed upon it. And all the parties that we've had listed here are demonstrating that is the case. So when you look at the GSE standards, they are building systems and processes that are very data-driven, that though maybe the balance of investors may not pursue, but my sense is that's a trend that you'll begin to see in more and more investors. When you look at the regulators, whether it's CFPB, whether it's the legislature and the way they look at Dodd-Frank, whether it's FHA, or whether you're looking at what the states and cities are doing themselves, a lot more of that regulation is based upon making judgments about the relationship between information and data that is in those loan files. So being able to both assess it, manage it, report on it, and then frankly be able to defend your stance based upon what's in those loan files is very critical. But when you look at the consumer and the investor, the consumer really does believe that speed and their interests are served by being able to get it right the first time and to make an event occur versus have to deal with a process that could take 30 or 45 days. And frankly, there is a whole industry that's building a set of capabilities and has acquired risk capital that's pursuing that with vigor. But ultimately, when you look at the investor demands, and I'm really talking about non-GSE investors, data equals trust. And the ability to be able to take a look at that data at a level of frequency and then frankly know that that's persisting from the point of origination gives a tremendous amount of confidence that is objectively observable for the assets that are in play. I'd posit to you that being able to make this occur in a fashion that allows an originator to make a dollar as well as gives the investor more confidence in their ability to hold those assets for the duration is really at the key of a digital e-mortgage process. And eOriginal has a tremendous amount of experience making that occur. When we look forward into what it's going to take and how competitive advantage will occur, I'd suggest to you that the trends that we've talked about today will begin to play out maybe with different sets of players, maybe not all at the same time, but will certainly be a manifestation of being able to take the information that you have in the process and to be able to manage it and manipulate it more readily and expose it to the parties that need to be able to gain confidence by understanding it.
Tom and Steve, thank you very much. This has all been very encouraging for, I think, both traditional as well as new players, and more importantly, it's actionable. Now, looking at our time, let's turn to some of the questions that have come in. Steve, the first one's for you. You mentioned earlier that this eMortgage platform is already being used in the vacation ownership space. The question is that just a test environment, or is it actually closing mortgages? And if so, are they going into the secondary market?
Yes, Jim. This platform has been up since the middle of 2014. The warehouse lenders include Capital One and Bank United and others, and the warehouse custodian is Equity, which we've spoken about. There's been about 63,000 mortgages which have been executed fully electronically, and that goes from an application on a Surface Pro all the way out into the secondary market. The first securitization of these electronic mortgages using our eOriginal platform was just completed in 20th of November of this year. And so it's now in 4 states, Florida, Nevada, Tennessee, and Utah, and we're looking to expand that or double that in this coming year just with this one particular application.
Okay, thank you. Tom, the next one's for you. You mentioned the GSEs. Do you think they're going to be an enabler for moving ahead with fully electronic mortgages, or you still see them somewhat as an inhibitor?
My perspective, and my perspective is informed by the fact that I do business with the GSEs. I don't necessarily work for either one of them today, is that there is a tremendous amount of interest by the GSEs in moving forward in this space. I think the one thing that they've learned, not to speak for them, but to just observe, as I've observed, is that in the past, as an investor, it's very difficult to get the mortgage to adopt something that really does require an originator and all the service providers to adopt without some set of incentives. The actions they've taken around data standards begin to direct folks that being able to manage data and an electronic approach is the right response. But I think the efforts they're going to take moving forward in supporting the furtherance of those data standards, as well as supporting their role as an investor, being able to use this transparency to their advantage, will really be one of the ways that you'll see the GSEs and other investors begin to embrace this as the way to do business.
All right, thank you. Steve, another one for you. You mentioned earlier some of what you've done with marketplace lending or the alternative lenders, and you mentioned a couple customer names. How many have actually adopted eOriginal? Any estimate on that?
Oh, yes. Between originators and investors, about 24. We are adding them weekly. The marketplace lenders are moved very, very quickly. We have another dozen in process, and actually we executed an agreement yesterday afternoon with one of the hedge funds that is working with one of our originators.
All right. Tom, I want to follow up on marketplace lending for a minute. We see that this space is starting to get a little more regulatory scrutiny. Do you see this as a factor that it's going to limit that new market's growth?
No, I don't. I actually don't think it's going to limit the growth. I mean, one of the things that, just to build a little context here, the marketplace lenders do find themselves scrutinized today by regulators, so it's not new. As a matter of fact, if you think of them as non-bank banks, they suffer a tremendous amount of scrutiny today by every one of the regulators trying to make a judgment about how they are performing as a non-bank bank. Moving forward, I think the real advantage they have is that if you begin to think about that regulatory scrutiny and you build to integrate that scrutiny into the way you operate your business, and it's a digital response, it makes compliance less of a burden because you're going to have access to the data. And the one thing that they've done very well is that they've made data the center of how they plan to respond. So I actually don't see further regulatory scrutiny being a big challenge for those organizations. I actually think that they're going to embrace it and they're going to be able to respond to it fairly readily, and in many ways may show the balance of us with some of how easy it can be and what some of the advantages are of being able to do so.
So what you're saying in essence is if executed correctly, the marketplace lenders could use the reduction of the complexity of compliance as a competitive advantage.
I actually think the way they're going to go about managing it, because it's very data centric and it's employing a lot of the capabilities that we've talked about today, is going to make that they're going to have, in effect, a muscle, if I were to use a metaphor, a muscle around being able to respond to regulatory demand that is very vigorous, very well formed, and very disciplined, because they've started from a stance where they're managing the data, and the regulators have proven that path is the path they want to pursue. So I'd say they're very well positioned versus the traditional organizations that have focused more on documents and less on data, it's going to be difficult to respond to a data request if your unit of measure is a document. And that's the comparison I'd like to draw. And that's why I think it's going to be really important for legacy lenders to be able to get control of the enterprise data and then be able to use that data as constructively, not only for regulatory responses, but also to understand what's going on in the marketplace and to be able to develop new products.
All right. And Steve, another one for you. The question is, do you expect to add additional partners to this platform you've described, and would you exclude anyone?
Oh, no, absolutely not. In fact, we've talked to some people today that would like to get involved in the platform. There's absolutely not going to be anyone that's excluded. Obviously, we are rolling out in Q1. There's going to be some time frames as to who we're going to be able to phase in when, but no, we're really open and, in fact, would welcome participants. And if anyone is interested in talking to us about this, I ask that they please reach out.
All right, thank you. And again, I'd like to thank both panelists. And folks, we're going to close here in just a minute. I want to remind you that we will be providing a recorded version of this webinar tomorrow. You will also be receiving pilot information, as well as be invited to follow-up webinars that will highlight some of the industry partners that we've mentioned today. We'd like to thank you again for your time and attention, and this will conclude today's webinar. Thank you.